today. Today we will focus on the cash budget. So we are provided with information relating to Greystone Stores. The business is owned by Jerry Williams. The business uses a markup of 80% on cost. So meaning that you have cost price plus markup is equal to selling price. So the markup is given as 80%. So the cost price is always 100%. So cost price plus markup is equal to selling price. So the selling price is 180%. Okay, prepare the collection for November and December, and then also the cash budget. Okay, here's the information. So let's start with the debtors collection schedule. Now, here we are given the answer sheet. So the credit says they are already here given. Now let's go back to the information. What did they say about the debtors? Now, they said credit sales comprise 40% of the total sales. So this means that 60% is for the cash sales. So this means that 60% is for the cash sales because the 40% is for the credit sales. Okay, letter A. The average collection from debtors over the past 6 months is provided below. This rate is expected to continue over the budget period. 25% is paid in the month of sale. 25% is paid in the month of sale. Now, let's come back to the answer sheet. So we have September, October, November, December. Okay, so 25% is paid in the month of sale. Now, let's say that, for example, let's start with September. So if September is the month of sale, it means that 25% is going to be paid in September. And then in October, 60% pay 1 month after the month of sale. So 60%, remember we are saying that right now September is the month of sale. So this means that 60% is going to be paid in October. Okay, and then 10% pay 2 months after the month of sale. 2 months after September is November. So in November, 10% will be paid. Okay, so this is it. It's already given here. And then now let's go for October. Let's say October is a month of sale. So if October is a month of sale, 25% is paid in the month of sale. This means that in October, 25% will be paid. And then the month after October is November. And then they are saying 60% 1 month after the month of sale. So we are saying October is the month of sale. 1 month after October is November. So 60% will be paid in November. Okay. And then 10% pay after the month of sale. 10% pay 2 months after the month of sale. 2 months after October, that is going to be December. So 10% is paid in December. Now, let's come back here. Now, so we are already given the credit sales. So we're going to have 149,760 multiplied by, so 149,760 multiplied by, so we are told that 60% is going to be paid in November for October. So 60% is going to be paid in November. So times 60%, it is 89,856. It's 89,856. And then 10% it's paid in December. So we're going to have 149,000 760. The credit says for October times 10%. So 149,000, 149,760 multiplied by 10% is going to be 14,976. 14,976. That is for December. 14,976. Okay. Now we are in November. For November, okay. Now let's start for November. Now, let's say November is the month of sale. So if November is the month of sale, it means that 25% is going to be paid in November. And then 60% will be paid in December. And then 10% is going to be paid in January. But then we are not doing for January. We are doing for November and December. Now let's go to November. So it's 161,000. So here, 20% is going to be paid. 25%. So times 25% is equal to, so 161,000 to 80 multiplied by 25% is equal to 4,320. That is for November. 40,320. So the one for December is already given. Now let's go to the December. So also for December it's already given. So let's totalize here. We're going to have 3. We're going to have the total for this is going to be 144,576, and then 158,562. Okay, now so this is going to the cash budget as a collection from debtors. So the collection from debtors for November, the total is 144,576, and then for December it is 158,562. Okay, so we are done with the debtors collection. Now let's come to the cash budget. Cash budget. Letter E. The business replaces stock on monthly basis to maintain a fixed stock level of 200,000. So what does this mean? This means that whenever the business sells the stock, the business will also buy the stock so that they can replace what they have sold. Okay, but then okay, so let's continue. And then they are saying the business buys 70% of its trading stock on credit. So the business buys 70% of the trading stock on credit. Okay, now, so let's come back to letter A. The business replaces stock on monthly basis to maintain a fixed stock level of 200,000. So this means that whenever the business sells the goods, or whenever the business sells the stock, the business will also have to buy the stock that is worth that much. Okay, so now let's look at the month of November. In the month of November, the sales they are 403,200. 403,200, right? So these are the sales. So we want to know that actually how much is the stock of this, because this is the money for the sales. So we must find the cost price of this amount so that we know the value of the trading stock that is going to be bought back by the business. So we're going to say multiply by. So we were told here that the markup is 80%. So if we want to find the cost of sales, we're going to say times 100 over 180 is equal to. So 403,200 multiplied by 100 divided by 180. This is going to give you 224,000. So this means that the cost of sales for the month of November, they are 224,000. You need to remember that the cost of sales, they go together with the trading stock. Okay, now, so this means that because of this information, this means that the business will have to buy a trading stock that is worth 224,000. The business will have to buy a trading stock that is worth 224,000. Okay, because we are told that the business replaces stock on monthly basis to maintain a fixed stock level. So whenever the business sells the stock, as they did here in November for 403,200, the business will have to replace the stock. Okay, so this means that in November they are going to buy a stock that is worth 224,000. Right now, and then we are told here the business buys 70% of its trading stock on credit. So what does this mean? This means that 30% of the trading stock is bought for cash because 70% is on credit. So this means that 30% it's on cash. So 224 times 30%, it is going to be 67,200. So these are the cash purchases of the trading stock, the business buying the trading stock. So these are the cash purchases for November. So the business is going to buy the trading stock that is worth 67,200 for cash. Remember, in total, it is going to buy a trading stock that is worth 224. Now, let's go to the one that was bought on credit. 224,000 multiplied by 70%. We want to know the trading stock bought on credit. So 224,000 multiplied by 70%, it is going to be 156,800. Right? But then 156,000. So the business buys 70% of its trading stock on credit, and then creditors are paid in the month following the month of purchase. Okay, creditors are paid in the month following the month of purchase. So this means that this trading stock that is bought on credit in November, this means that this trading stock, remember this is for November. Look at this. Remember this is for November. Okay, now, so they're saying that creditors are paid in the month following the month of purchase. So this means that this trading stock that was bought on credit, of 156,800 is going to be paid in the month following the month of purchase. Which month is that? It is December. So this means that this trading stock is going to be paid to creditors in December. This 156,000. But then they said less 5% discount. Creditors are paid in the month following the month of purchase to obtain a 5% discount. So this means that when the business pays their creditors, they are going to pay less 5% discount. So how much is that after the discount? So times 95%, it is 148,960. 148,960. So the business, they are going to pay the creditors in December 148,960. It is a payment to the creditors 148,960. Okay, let's continue. Letter G. A loan repayment of 24,000 is scheduled for 1 December 2020. The interest on loan is paid monthly. Okay, the interest on loan is paid monthly. So they are telling us that 24,000 is going to be paid in 1 December. So let's go to the payments. So we have a 24,000 that is going to be paid here in December. 24,000. So this means that now the loan is going to decrease. The loan is going to decrease because right here the balance of the loan is 360,000. So it's going to decrease by the repayment of 24,000, right? Which is going to give us, so 360,000 minus 24,000, it is 336,000. So that is the remaining, loan. So this means that in December, the interest on loan is going to be calculated from 336,000 because in December the loan is not going to be 360, it is going to be 336,000. So multiply by 10%. So we are calculating for only 1 month, so times 1/12. So times 10% times 1 divided by 12, which is equal to 2,800. So the interest on loan for December, it is 2,800, right? The next one, letter H. Interest on fixed deposit is received quarterly. So quarterly, it means that it is received 4 times a year because the year has 4 quarters. The year has 4 quarters. 1, 2, 3, 4. It's the first 3 months, second 3 months, third 3 months, and then fourth 3 months. Okay, it's like this. Now, the interest for the last quarter is due on 31 December. So the business is going to receive this interest on 31 December. Okay, now let's go and look at the information. The fixed deposit is 80,000, right? The fixed deposit is 80,000. Let's check what did they write here. So there's nothing here. So multiply by 6.5%. We want to know that how much is the interest. So is equal to, so 80,000 multiplied by 6.5%, it is going to be 5,200, right? So we are told that the interest on fixed deposit is received quarterly. So this means that the interest on fixed deposit is received 4 times a year. Because this percentage is saying per annum, it means that this interest is for the whole year. right? But then we know that the interest is paid 4 times a year. So we want to know that it is paid by how much? So 5.2 divided by 4, it is 1.3. So it is paid quarterly for 1.3. Every quarter, 1.3. But then the remaining quarter, it is December. So this means that in December, we are going to receive an interest of 1.3. Letter I, salaries. The store manager earns 20,000 per month. Okay. However, from 1 December, now let's go and look at the answer sheet. Salaries for the store manager, it's written here for November, which is 20,000. Okay. However, from 1 December 2020, his salary is going to increase by 20%. So in December, his salary is going to increase by 20%. So this means that his salary is going to be 20,000 times 120%. Or we can just say, maybe because you won't get this one, or we can just say times 20%. Times 20%, 20,000 times 20%, it is going to be 4,000. So then we add it to this 20,000, that is going to be 24,000. So this means that this store manager in December, he's going to earn 24,000. Okay, he will also receive a bonus in December equivalent to his December salary. So this means that actually he's going to receive this salary 2 times. It's his salary plus the bonus, which is going to be 48,000. Remember, they said his bonus is going to be equivalent to his December salary. So his December salary is 24,000. So it means that we are going to have two 24,000s, which are going to give us 48,000. So in December, the salary is 48,000, right? Now, the business employs 10 sales assistants. Okay, let's go and look at the answer sheet. Sales assistant. So we are only given the salary of November, which is 62,400. Okay, now, and then what did they say? Each earning 6,000 per month. So they are 10, and then each is earning 6,000 per month, which is equal to 60,000. So this means that 60,000 is paid to the sales assistant. They will receive a salary increase of 4% effective from 1 December. So they're saying that in 1 December, they are going to get an increase of 4%. How much is that? 60,000 times 4%, it is going to be 2,400. So which is going to be, if you add these two, it is going to be 62,400, right? 62,400. But then that is already given here. So this means that here in November, the salary is going to be 60,000 because here in November, it's before the increment. So this amount here is for December. So the one for November, it is 10 times 6,000, which is equal to 60,000. This is for November because this is before the increment. Okay, letter J. The owner's monthly drawings are as follows. For the goods, so if the owner is withdrawing the goods, the cash is not affected there. So therefore, the cash budget is not affected. You need to remember, the cash budget deals with the cash only. So if the owner withdrew the goods, no cash is affected. And then they are saying he withdraws also the cash of 30,000 per month. And then they are saying the owner intends increasing his cash drawings to 50,000 in December. So the owner is going to increase his drawings in December to 50,000, right? And then letter K, equipment costing 20,000 will be purchased for cash. We need to remember we are dealing with cash, because if they said it was purchased for credit, we were not going to record this in the cash budget, because the cash budget deals with the cash only. Okay, it is going to be bought at the beginning of December. So there's an equipment that will be bought in December, which is worth 20,000. So these are the payments. And then letter L, operating expenses are expected to increase monthly in line with the current inflation rate. So the expenses are expected to increase. Now, let's go and look at the, so we are given here the operating expenses, they're 145,886, 145,866, right? That is for December. So, but here we were told that expenses are expected to increase with in line with the current inflation rate. So let's do it like this. So let's say that because here the increment is 5.7%, this means that in this 145,866, it is 100% plus the increment. Actually, this is worth 100% plus 5.7%. So what do we do? Below, when we're doing this, we're going to say below we put what we have. So what we have is 105.7. And then what we are looking for is the month of December. We are looking for the operating, we are looking for the operating expenses of November. So the operating expenses of November, we are going to say that they are 100% before the increment, right? So how much is that? 145,866 multiplied by 100 divided by 105.7, it is going to be 138,000. So these are the operating expenses for November. Okay. Part of the buildings are rented out at a monthly rental of 5,000. So we're told that the business is renting out at an amount of 5,000 per month. So this means that also in December, the rent income is going to be 5,000. Now let's do the calculations. So the total receipts, they are going to be 291,496. Then for December, okay, and then the total payments that's going to be 456,520, and then December 580. Now, to get the cash surplus or shortfall, we must say total receipts minus total payments. So total receipt for November minus total payment for November again, that is going to give you a negative 65,024. So if we say negative 65,024, plus 138,400. That is going to be 73,376. Then we know that we need to transfer this at the beginning of the next month. So, and then we do the same thing again here in December. We say total receipts of December minus total payments. It is going to give you 134,364. So if you add this, they're going to give you a negative 60,988.